Hello, this is the latest Gold and Away business news release. The price of gold is expected to rise in 2023, primarily driven by intermarket dynamics. The odds favor a slowdown in the rise of both the US dollar and bond yields, particularly as 2023 progresses. The US dollar and bond yields are leading indicators for gold. Moreover, inflation expectations should continue to rise in 2023, and the monetary continues to expand. These expected trends in gold's leading indicators should be supportive of gold. Based on the long-term charts, which show gold's dominant patterns, we expect gold to consolidate in a wide range of $1,600 to $2,000 per ounce. We expect a long-term bullish reversal to sign up on the gold chart, which will set the stage for gold to eventually break out to new ATH with $2,500 as a first bullish target and ultimately $3,000 to be hit several years out though. While the breakout above $2,000 occurred, it didn't hold because of monetary policy interventions. Deflationary policies pushed commodities lower. Still, gold didn't react to the inflationary results. This is the point. Monetary policy became restrictive, preventing precious metals from adjusting to the higher price points across the board. Prices overall are decelerating their trend. They remain upward. That's why we believe gold will not enter a bear market, but gold will consolidate before moving to new highs at a later point in time. The long-term gold price chart shows a long-term bullish reversal between 2013 and 2019. The price of gold created either a topping pattern in 2020 and 2022 or is in the process of creating a cup and handle. We cannot rely solely on the gold price chart to make the call on which of the two scenarios are most likely. We need the leading indicator to help us understand which pattern gold might take. The same findings that we get from the quarterly charts shown above are visible on the long time frames of gold's historic interactive chart. Very important, the correlation between the price of gold and the monetary base M2. As seen on below chart, the monetary base M2 continued its steep rise in 2021. It started stagnating in 2022. Historically, we see that gold and the monetary base move in the same direction. Gold tends to overshoot the monetary base, but mostly it tends to happen temporarily. The divergence between the price of gold and the monetary base is too wide right now. We expect the monetary base to remain flat or rise in 2023 and gold to eventually catch up. We apply a limited number of leading indicators for our gold price predictions. The euro inversely correlated to the USD, bond yields, inflation indicators. All three combined help us forecast the future path of the price of gold. Moreover, it's by using these three indicators that we were able to accurately forecast annual gold price targets some 9 months prior to the market hitting them. Gold's leading indicator number 1 is euro to USD. Gold tends to go up when the euro is in a bullish mindset. Consequently, when the USD is rising, it puts pressure on gold. We need to understand these secular patterns in order to get an understanding of gold's projected path. The longest-term euro chart has two targets, 0.9666 10,000s and 0.91 1000s approximately. As seen, 0.9666 10,000s was achieved in September of 2022. This level coincides with the lows printed in 1989, a very important price point simply because it goes back so many years in time. We don't see the euro falling below the 2001 and 2002 lows. This should prevent gold from starting a long-term bear market. Gold's leading indicator number 2 is bond yields. Bond yields are inversely correlated to gold. They are not as strong a leading indicator as the euro. Gold can rise when bond yields are flat or range-bound. Treasuries are negatively correlated to bond yields. Treasuries are positively correlated to the price of gold, and it should be combined with the euro trend to get the full picture. The long-term 20-year Treasuries chart, TLT, helps us to understand how future trends might impact gold. The long-term TLT chart went from 180 points to 100 points in 24 months. This is historic, never happened before. We don't expect treasuries to continue their decline. We expect them to stabilize around current levels. Stated differently, there is more upside potential than downside potential in treasuries. So, in terms of impact of currencies on gold, we believe there is more upside potential than downside potential in the euro, positively correlated to gold. Although over the long term, which means at least 12 months out. Also, in terms of impact of treasuries on gold, we believe there is more upside potential than downside potential in TLT. Both should prevent gold from falling in a long bear market and should support our thesis of gold being range-bound in 2023 before continue its uptrend. Gold's leading indicator number 3 is inflation. Gold shines in an inflationary environment. Inflation expectations expressed by TIP ETF came down in a dramatic fashion. We don't expect this trend to continue in 2023, especially since monetary policies are close to being stretched in terms of rate hikes. Moreover, TIP came down to a long-term trend line support, which connects the lows of the epic 2008 and 9 years and 2020 market crashes. We expect gold to be supported in 2023 by TIP, which eventually will stabilize and start rising again over time. Monetary inflation is easing, but eventually it will move up again. The divergence between gold and the monetary base will moderate eventually. When we look at the historic relationship between TIP, gold, and stocks, we can see how a decline in TIP has led to lower gold and stock prices. However, as TIP is hitting long-term support, it should suggest that gold and stocks will move higher in 2023, although it might happen at different points in time. It is clear that we have sufficient confirmation from the gold chart patterns on all time frames, as well as gold's leading indicators that gold may stabilize and remain range-bound in 2023. The US dollar does have less upside potential than downside potential in 2023. The same accounts for treasuries. Inflation expectations should resume their uptrend at a certain point in 2023. Golden way: think different, earn different.